more, I'm joined by Kevin Book, Managing Director at research firm Clearview Energy Partners. Kevin, welcome. And this, first of all, is the gas price higher than it normally would be based on where oil prices are?
Yeah, there's a wider spread right now, particularly if you go back a few weeks when the oil prices had retreated, the gasoline prices stayed high. That reflects dual shortages, not just a tight crude oil market, but also shortage of refining capacity.
Can you explain that a little bit more? How do we get into this situation?
Well, part of the situation has to do with inefficiency in the refining fleet, and part of it has to do with COVID. Roughly 3 million barrels per day of global refining capacity shut down in 2020 and 2021. Of course, demand rebounded, and so we find ourselves short of the processing capacity to refine crude oil into products like diesel and gasoline. Part of that is a rationalization. It takes a while to build and expand refining capacity, so you won't see an immediate response despite the shortage. But of course, demand came roaring back, and inventories for diesel, as you mentioned, 22% lower year on versus the 5-year average for this time of year, and gasoline down 8% versus the 5-year average. Those are pretty significant deficits.
Are we likely to see shortages or outages?
Well, absolute shortages and interruptions in supply are pretty rare these days. Right now, if you think about the sort of shortage in the world, though, energy writ large, coal, oil, natural gas, electricity made from primary sources, it's all short because Russian energy is going off the market. So we have essentially a structural inventory problem that's turning into a secular shortage. The more we push Russian oil or gas or coal or anything off the market with political and geopolitical action, the tighter it gets.
And we're kind of stuck because if the U.S. economy hangs in there, then these shortages could become more of a problem. If the economy slows, it's sort of a lose-lose. You know, you either get possible shortages or you have a worsening economy. What could D.C. do about this, specifically to get at the refining issue and try to narrow that spread so that at least gas prices aren't trading any higher than they otherwise should be?
Yeah, there's very few tools, of course, to bring on capacity. If there were some sort of autonomous pool of gasoline they could pull from, and they have one, but it's very small and won't make a difference, then perhaps there could be something. There are a few changes they could make to the fuel specifications that are required by the Environmental Protection Agency. They've already made one of them, is to allow E15, ethanol blended at 15%, essentially year-round. That's a very small change. There's other air waivers they could explore, but you're going to get 100% environmental pushback for single percentage point changes in pump price at best. Some of the other changes involve the Jones Act, which requires U.S. flagged crude and manufactured tankers coastwise trade, allowing foreign tankers to carry gasoline from the Gulf of Mexico to the East Coast ports. Again, a big political headache, maybe a lot of pain for not much juice squoze. So in the end, the refining capacity issue doesn't have a lot of short-term solutions. One thing that does not help, talking about gouging and scaring away capital investment. I think you're going to see a lot of that, however. That's where D.C. is going.
Well, I think the concern is they could scare away the supply while at the same time passing gas tax cuts that increase demand. So you greatly worsen the problem. But in the meantime, we're sort of stuck with a situation where prices are you think they're likely to keep going higher every day? I mean, structurally, could we hit $5 or $6 a gallon for gas?
Well, that depends an awful lot on the shape of whether or not we see a real embargo of Russian oil and whether it doesn't go to other ports or markets. The possibility is certainly out there on a major outage of that sort. It also is possible that because of some of the other factors in the world, we could see a refinery fire or outage that could limit refining capacity in a big way. So, yeah, it's certainly in the realm of possibility.
So final question, what do you think the impact is likely to be on the economy and consumer? Because obviously in inflation-adjusted terms, we're still below where we peaked in 2008, but we're getting closer and closer with every passing day to what could end up being highs in real terms in what people are spending here.
And this is the grimmest part of it all, because so much of gasoline demand consumption is inelastic, and most so for those people who have to drive to work and to school. Usually the lower income folks who have jobs they have to attend in person have least flexibility. So what you're talking about is on the percentage of disposable personal income per capita. We're at about 3.1% right now, which is up a lot, up from 0.85% at the April 2020 troughs. Fast acceleration. And effectively, you think of it as a tax on consumption writ large. But it's also well below where we were if you look at the late 70s, 7% thereabouts. So you could say, well, it's not so bad. But truly it is. The rate of change has been so fast, and so many people had government money in their pockets they've now got smaller wallets and bigger gasoline bills. So bad news.
Absolutely. Well said, Kevin. We will leave it there. Thanks for your time today.
Thanks for having me.
Kevin Book joining me from Clearview.